Hi, I'm Jack and welcome to the Attract Capital webinar series. Today I'm here with Attract Capital CEO and founder David Barnett.
Hi everybody!
Today our webinar title is What is a Mezzanine Debt Warrant? So Dave, can you give us some background on mezzanine debt pricing?
Sure, Jack. So there's four components to mezzanine debt pricing. You have the upfront fee, then you have the current pay interest, you have the payment in kind or deferred interest, and then you have the warrant. And basically the upfront fee is 1 to 2%, the current pay interest is 10, 11%, and the PIK interest is 1 or 2%. The warrant is always different for each and every deal.
And then what is the concept behind the warrant?
So the warrant is the extra return that the lender needs to achieve their targeted rate of return. Their targeted rate of return is generally in the 14 to 16% per annum. If you add up the components that I laid out on the fees and on the interest rate, that might only get them to say 13% on an annual basis. And if they're targeting to make 16%, they need to pick up an additional 3% in order for that investment to work for them and to achieve their hurdle rate of return, which is 16% per annum. So that's really what the warrant does. It fills the gap between the contractual interest that the company's paying and the rate of return that the lender needs.
So technically, what is the warrant and how does it work in a live deal?
So the warrant, it's funny, Jack, it sounds like a really bad word. It sounds like something bad is happening when a warrant is created, but in a mezzanine debt deal, it's a very common part of every transaction. It's a very benign thing, and it's a very collaborative and cooperative thing between the purchaser of the warrant, which is the lender, and the issuer, which is the company. So it's really a contractual agreement between the issuer and the purchaser. It creates an obligation for the borrower to purchase it in the future at a specified formula price. That formula price is variable based upon the future EBITDA of the company. So the most commonly utilized valuation approach is the fair market value approach. And essentially what that involves is taking the future EBITDA, applying a multiple to it to get to the enterprise valuation, and then subtracting the debt from that enterprise valuation in order to get to the net equity. So that's the approximation for how an appraiser would think about fair market value. And usually there's a provision that says that the purchaser, which is the lender, can put the warrant to the issuer after a certain period of time, and the issuer can call, which the borrower can call the warrant from the purchaser after a certain period of time. It's really, what usually happens is that if the lender's getting repaid, the company that is repaying the loan, the lender will say, well, you're gonna have to pay off our warrant as well. So it's usually not something that's hotly negotiated. It's usually not something where there's a lot of acrimony or hostility in terms of deciding what it's worth. It's done in a very friendly kind of a relationship-based approach. And I've been involved in 200 mezzanine debt deals over the last 32 years, and I've never seen a warrant get into a really difficult situation. It's usually resolved in an amicable fashion, because once the lender finds out that you want to refinance them, they want to make sure that they can get some liquidity on their warrant.
And then what outcomes do you usually see with the warrant?
It really, because it's a variable mechanism, and if the EBITDA goes up over time, let's say that if a lender owns 3% of the fully diluted shares in a warrant, if the company goes up, if it does really well and it outperforms, then they'll have a good return, a very good return on their warrant. If the company just goes sideways, there's very little return. If the company underperforms and goes down, there's no return. So it's very symmetrical with the financial performance of the company. There's no situation that I've ever been involved in where if the company does really poorly, the warrant is worth a lot of money, or if the company does really well, the warrant is worth a little bit of money. So it usually is aligned with the performance profile of the company.
Well, there you have it. Thanks for tuning in, and we look forward to seeing you next time on the Attract Capital webinar series.
Thank you.